Good morning and welcome to today's webcast, 2017 Year-End Tax Update for Community Banks. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Thank you everyone for joining us today. I'm happy to introduce our presenters from Moss Adams, Kristine Hoeflin and Amy Jessup. Kristine, I will now turn the line over to you to get us started.
Great. Hello, and thank you to everyone for joining us. I'm Kristine Hoeflin, tax partner with our firm's financial services group, and joined by Amy Jessup. And Amy and I have the privilege of working with dozens of community banks throughout our firm's footprint. And with the smell of tax reform in the air, we certainly are in the weeds of all things that relate to tax reform as it relates to your institution. From an agenda standpoint, we'll be spending the bulk of the hour on the federal tax reform package and what that means to your institution and your customers. And as you can imagine, we prepared these slides a number of weeks ago, and with the changes that have been continuing to come through Congress these last handful of days, weeks, we've been making edits as we go, and that has had the effect of recognizing that some of the slides at the tail end of our agenda, information return, some of the state tax update, we may not have time to get to those because of the changes that have come through in the last handful of days. However, we do have those in there for a resource. Before we move on, we do also want to thank you to Scott Weedle and Career OneSource for their partnership. Scott and his team at Career OneSource are there for your recruiting needs. All right, the headliner. So everyone, I'm sure, is quite familiar that the big headliner of this tax reform bill is that the corporate tax rates would be lowered from the top rate of 35% down to a 20% flat corporate rate. So clearly what we see in that is a long-term benefit as we march towards reduced corporate tax rates. And in the meantime, there's the big question mark of what does this mean to my large deferred tax asset that's sitting on my books. We'll take a look at that here next, but a couple of things to note between the House plan and the Senate plan. The House plan looks at changing the rates as soon as 2018. So we'd get here to end of 2017 using the 35% rate, and then 1/1/18 you would see an effective rate of 20%. The Senate plan uses that new rate in 2019. So it's a year deferral. We'll take a look at what that deferral might have an impact on your deferreds here later in the presentation. From the standpoint of preparing for what the changes in rates might mean to your financial statements, this illustration here is something that we've been talking with a number of our clients about, just to simplify looking at what you could expect to occur with your financial statements. In this example, this institution had $35 million of timing differences. So commonly, there's the allowance for loan loss sitting there at $20 million. You have your accrued compensation, other accrued expenses, that's the deferred tax asset. You have your common deferred loan fees. We've got some adjustments for OCI, and overall $35 million of timing differences. This sample institution is in California, so they valued the deferred tax asset at $14.7 million. To complete the illustration, they're running about $20 million in pre-tax income and permanent differences each year. So at their blended tax rate of 42%, they're looking at annual tax of about $8.5 million. If this institution was to prepare for what's expected to come, what you see there in the right-hand column is the $35 million in timing differences on the date of enactment. So at the date the president signs things into law, would need to revalue its deferred tax asset for the new expected rate of reversal. So in this illustration, and this one would align with the House plan that would look at what will be the new rate, say in 2018. What we're looking at is a new blended rate of 28.67. So you can see that with a California institution, you don't see a straight 15% drop because of that federal benefit of the state tax expense. So you can see a little calculation down there in the bottom right-hand corner. But applying that blended rate, the new value of the deferred tax asset becomes $10 million. And that revaluation that then hits the P&L, again in the quarter the president enacts this into law, would be the $4,682,000. So what's significant here is the timing of whether this comes through before Christmas or in the new year. And what we're really paying attention to is do we see that signed in Q4? We'll see the large revaluation hit in Q4. If we see it signed in January, we see that come through in Q1 2018. This particular institution then is looking to what can I expect for benefits each year going forward. At that $20 million of pre-tax plus perm at their new blended rate of 28.67, you can see that their revised tax expense going forward is looking to be about $5.7 million. So their annual savings that they would see on a go-forward basis would be in the ballpark of $2.7 million. And so the takeaway, or what I would always want to get to, is how long before I really see a benefit now that I have to take this huge haircut on my DTA, is 1.8 years. And that's looking at the relationship between their revaluation in this example of $4.7 million compared to their annual savings. So a couple of takeaways before I move on from this slide. If you're bringing it home to your institution to say, what does this then mean for me? You're looking really to the relationship between your total timing differences, so the $35 million here, and what you're generally running for your pre-tax income plus your permanent differences, so the $20 million. So that break even is really looking at what's the relationship between my pre-tax plus perm versus those timing differences. The second takeaway is that to the extent that we can reduce those timing differences, clearly your break even is quicker. You get some permanent tax savings from any additional deductions that you can create at a 34 or 35% rate. So tax planning right now has an incredible amount of value. The third takeaway is you can see in this schedule that the OCI components are there listed as a timing difference. Many of our institutions have mark-to-market adjustments on available for sale securities, for example, and those unrealized gains or losses, when they do get revalued for this tax reform proposal, those revaluation adjustments do run through tax expense. So you will not see that adjustment backing out through OCI. It will actually hit the P&L. One thing to note about that is if you are then in that example sitting on unrealized losses on securities, now is a great time to be thinking about whether it makes sense to sell some of those securities so that you can realize those losses at your higher tax rate, at your 34-35% tax rate, so that you can secure the losses with that extra 15% benefit, as opposed to holding on to those into periods where the tax rate may be lower and those losses are worth less. So as I noted earlier, now is a fantastic time to be looking at tax planning because, again, to the extent that we are able to bring your deferred tax asset down, you see permanent savings. So who wouldn't want to take depreciation at 35% rather than take it down the road at 20%? So there's a handful of things that we can readily look to that would make sense to lower that deferred tax asset before reform goes through. And as noted here, we've got a handful listed. So tax methods, it's always a good idea, especially in this environment, to scrub the methods that you're using for tax purposes. That's something that you can certainly work with your tax team on doing, just to see if there's anything that has been on the table in past years that, because of time, value, and money, hasn't been changed. For example, some of our institutions have not been deducting loan costs in the year of origination. And so we've likely been talking about, do you want to make that change? And if it's a small enough number, it doesn't always make sense with time value of money. But if it's a large enough money or a large enough number, it would. But when you start talking about a 15% rate differential on making that change, then the effort that goes into doing that makes a whole lot of sense. Prepaid expenses is another one where we have a handful of clients we work with that aren't on that method yet. It hasn't made financial sense to go through the exercise in the past with certain institutions, but when you start talking about rate changes, now it makes a lot more sense to go through the exercise of doing what's called a Form 3115, which is a request for accounting method change. There's items that you can look at for accelerating deductions. So just simply thinking about the things that you have planned for the bank, and are there things that make sense to take care of in 2017 rather than 2018 so that you can accelerate certain deductions. Some of these would be looking at things that are going to be the same for GAAP and tax, or there are certain actions that you would take that would trigger deductions for GAAP, and we'd piggyback right on that for tax purposes. And then others where we talk about fixing accruals, those are looking at things that you already accrue for GAAP and making sure for tax purposes that you've dotted your I's and crossed your T's in a way that allow you to take those deductions for tax purposes. So one good example there are bonus accruals. With a number of clients that we work with, we see that bonus accruals aren't fixed in such that if an employee leaves after year end, those bonuses don't get paid out. They don't revert back to a bonus pool to get paid out to other employees. And in that example, those bonus payments don't get deducted on the tax return until the year they're actually paid. So right now with the tax rate changing, it's a great time to be thinking about fixing those accruals, either working with your board to make resolutions, you'll pay certain amounts out, revisiting the bonus plan so that you can ensure deduction at the higher tax rate. Another item to be thinking about is increasing prepaid expenses. So with prepaids, the most common qualifying type of prepaid for a bank is insurance. And so looking at your insurance contracts, the rules generally require that you would have prepaids not more than 12 months to be able to qualify for deduction. But one thing a number of our clients are looking at is either prepaying those common insurance policies that you are on track with typically paying, and then looking at ones like prepaid health insurance and reaching out to your health insurance provider and saying, can you issue me an invoice so I can pay a number of months ahead so that we can secure that deduction a little bit earlier. Fixed assets is another great one. If you're thinking about triggering certain purchases next January, next February, To the extent that you can place those in service before the end of the year, that's fantastic. If we see these tax rates not come into play until 2019, that gives you another super year to be going through and making purchases that will qualify for increased deduction rate. And then likewise on that fixed asset realm, cost segregation studies, that's where you can look at buildings that the bank has placed in service and carve those buildings up into shorter lived assets. So rather than having a building on your books at 39 years and taking a slow amount of deduction each year, how can you carve up the building, work with a cost segregation team to carve that into 5-year assets, 7-year assets, 39-year assets, so that for those items that get the lower life, you're again accelerating that depreciation into higher tax rate periods. A number of things to think about that right now has significant amount of value. So as we look at these tax reform bills, one of the things that the Senate explicitly noted was that the idea of, say, moving the tax rate change to 2019 while having bonus depreciation opportunities and Section 179 expensing opportunities available, the idea behind that was to incentivize businesses throughout the U.S. to run out and purchase a whole lot of assets right now. And so the idea that you see in both bills is that these favorable expensing provisions have started already. September 27th allows you to start taking 100% bonus depreciation on a number of assets. The House bill even takes away the requirement for an asset to be new. The Senate bill didn't go that direction, but the House bill loosens that requirement. That's also often been a hiccup in the past in terms of taking bonus depreciation. And what you can ultimately see is that you've got a great time period to fully expense fixed assets that you purchase. As we take a look at a few of the impacts of the plans, a couple things related to the permanent tax rate change here. Investment planning, I've talked with a number of institutions throughout the year, just thinking about as you're purchasing muni, as you're purchasing BOLI, low-income housing credits, building in that rate of return at, say, a 20% tax rate is always a great thing to be doing. You know, I understand with the muni markets and the LIHTCs that those reduced rates have already been built into the pricing. And so that's fantastic that companies have already been anticipating that and just continues to be something to keep top of mind. Another thing to make note of is with the state changes. Certainly a lot of these changes discussed. Another term for this act was the Cuts Act. That didn't stick, obviously, but that was what was proposed at one point in time. And that is very much a federal mentality at this point. As we look to the states, I think we'll continue to see dissension between the federal tax code and some of these, and what the states end up doing in regards to some of these additional cuts that come through. And I suspect that once something gets passed for federal, you'll see the states scrambling to decide which of the various cuts, like depreciation, for example, the states will actually conform to.
I agree with you there, Kristine, and I'll go ahead and talk about some state tax trends as we get further on in the presentation. Right now, let's address two polling questions. So these polling questions are going to be back-to-back. Polling question number 1 is, do you anticipate that your company will make larger than usual fixed asset purchases or prepayments before year end in order to take advantage of the deduction when the rates are still higher? And this also applies to a pass-through scenario because it would also apply to taking a deduction in the year when the most benefit is received from it. So I'll give you all a couple of seconds to respond. I see we have about half of you have submitted answers. And just as a reminder, click on the button next to the answer and choose the Submit button to submit your answer. All right, I see some movement in these answers. Okay, we're almost there. And I'll post the results in just a minute. I'll give you a couple more seconds to respond. What I am seeing, though, is that most people do not anticipate, a little over half of everybody that responded would say, no, they're not going to change their activity. I wonder if that might change once everyone has gotten a chance to digest the impact. So I'm going to go ahead and post the results right now. Okay, there we go. And so there is a lot of I don't know answers as well. So I think you will find that after you've had a chance to digest everything that's going on with this tax reform, you might find that it will be more beneficial to implement some of those tax planning strategies that Kristine mentioned, to take the deduction in the higher tax year and to convert some of those timing differences into permanent differences. I'm going to move on now to the second polling question. And this one is a question that would affect the pass-through rate changes. So how will changes in flow-through tax rates for S corporations and partnerships impact your bank? So the answer might be, my bank is an S corporation, it impacts our shareholders and our borrowers, or my bank is not an S corporation, it impacts our borrowers and their cash flow, or I don't believe it will impact my bank or my borrowers. So while you are addressing that question, I just want to say that as a reminder, if you want to have a copy of the slide deck, you can download those from the folder that says slide deck and handouts at the side of your screen. And then also we will be sending those out via email after the webcast. Okay, so I'm going to go ahead and publish these answers now. And more than 50% said that it will impact your borrowers and their cash flow. So it'll definitely have an impact on the loan review analysis going forward. I want to point out that the tax reform does feel like it is largely geared towards a corporate tax reform. And I will point out how the pass-through rate changes will impact. There's very large differences between the House bill and the Senate bill. I'm going to talk about the House bill first. It's really a little lackluster, and it's fraught with a lot of details, and it's very complicated to digest. A lot of people don't like it, So I'm not going to go into too much detail on this because I think everyone has vocalized that they are a lot more, they're happier with the results of how the Senate bill turned out. So the House bill says that if you are receiving distributions from an active business, you can elect to treat 30% of that as business income and 70% of that as wage income. And then you're able to take a 25% maximum tax rate on the portion of that income that's treated as business income. One thing to point out is that passive business activities would be able to treat 100% of their businesses as the income as business income. So this is definitely geared towards benefiting passive flow-through income. What's nice about the Senate bill is it allows for a 23% deduction for non-wage pass-through income, and there's a lot less restrictions with the Senate bill. And it's actually quite beneficial if your taxable income on your individual return is not over $500,000 married filing jointly. So how the Senate bill works is that if you have domestic pass-through income, so that is the domestic part of it is a distinction that is made in the Senate bill. So you get to take a 23% deduction for your pass-through income as long as your taxable income is not too high. So once you get over $500,000 married filing jointly, then the deduction is limited to 15% of your percentage of the whole institution's W-2 wages. So there's a further haircut, and then as your income gets higher over that amount, then the haircut increases. So there's a little bit of detail on that, and I'm going to pass it back over to Kristine to talk about special interest provisions.
Perfect. Thanks, Amy. So one of the things that was commonly mentioned as Trump was on his campaign proposal and as the Republicans put their original blueprint out was the idea that special interest tax provisions would be eliminated. And so what we saw with the two bills that are out there, the House put more detail into the types of things that it expected to see repealed or transitioned away. So new markets tax credits, rehabilitation tax credits, tax credit bonds. These were items that transition rules apply to, so you would expect to see that no new bonds or credits would be issued in these realms. And then with private activity bonds, this is where you might work through, say, a government entity to create 501c3 tax-exempt private activity bonds. These also were seen that the way the bill's written would cause these types of bonds to no longer be tax-exempt on bonds issued after the effective date. And so what we see in the House bill is that they put time and thought into these, and my suspicion is that what you see in the Senate bill is that in working late past midnight on Saturday, that they ran out of time to deal with some of these things. So a number of these are silent in the Senate plan. We may see that they're retained. However, I suspect that as we go through the compromise period, that we'll see that some of these, quote, special interest tax provisions would potentially continue to be transitioned out. As far as what's staying, low-income housing credit was specifically noted to be retained in both the House and the Senate bill. So the credit is retained. One thing to be thinking about is that if your institution does have low-income housing tax credits and they're using the proportional amortization method for scheduling that out, with the new reduced corporate tax rate, that would impact your proportional amortization and will impact the remaining amount of amortization on those. So that'll be something that once this is signed into law, you'll need to revisit those schedules and take additional amortization. The research and development credit, this is generally less significant for our bank clients themselves, but fairly significant for a lot of their borrowers. This is another item that has been retained throughout the tax law write-ups. What we do see in the Senate plan is that deductions related to R&D in later years of the bill will be amortized over a number of years. However, the credit itself is retained. This next slide was of significant interest to our clients that are involved with mortgage servicing. What we saw with the Senate bill when it was first written is that there's a provision in there that requires income recognition to align with the timing of GAAP income recognition. And so for those of you that have mortgage servicing rights, which a number of our clients do, there's a significant deferred tax liability that are tied to those. Income is not recognized until that cash is actually received. And so what's occurred over the last handful of days is that lobbyists have been incredibly active. There's been a call to action. Some of you may have been involved with that. And what we saw is as they made their changes over the last week, they did go ahead and write into the law that mortgage servicing rights income is exempt from this inclusion accounting method proposal. So this is a great example of voicing opinions as we see tax reform go through. Certainly the voices of mortgage servicers were well heard when overlooked items of the tax bill were having impacts that weren't necessarily intended. A nice slash through that bill. Excuse me. Here we move on to indefinite net operating loss carry forward. So this one is of significance for a couple of reasons. When we look at our institutions, many of you have acquired banks with net operating losses, and oftentimes when we go through that exercise of doing purchase accounting, for example, you look at that 20-year carry forward period to decide what is usable to an institution, and then what will expire unused. So right now, currently we look at 20-year carry forwards. With an indefinite net operating loss carry forward, this gives you the opportunity to look further out to be able to use some of those net operating losses that may otherwise expire unused. From a GAAP standpoint, what it also means is that when you look at whether more of the net operating loss should be booked through purchase accounting, for example, you would be looking to understand how far out can you predictably schedule the use of those net operating losses. And in some cases, I know some of our banks have NOLs that maybe by the time you're done with using it because of Section 382 limits, you're out 103 years. It's awfully hard to find confidence in putting an asset on your books that'll take 103 years to use. But this, I think, will add some additional complexity to looking at ASC 740 and what it really means to have an indefinite net operating loss carry forward. Another thing about the way the bills are written, 90% of taxable income becomes the new threshold of income that can be offset by a net operating loss. So for banks working through their net operating losses, it was common to be hit with alternative minimum tax at this 90% threshold. And now what we'll see is just any corporation working out of their NOLs will have to pay tax on at least 10% of their income. The Senate bill further reduces that ability to use the NOL to 80% after 2022. So the idea, as they're looking to balance the budget, is to kick in some additional taxes being paid out as a result of this application of the NOL threshold.
Great. So we're going to move on to another polling question. So this one, we want you to consider the tax provisions that are outside of the rate changes and whether these provisions you think will have a favorable impact or an unfavorable impact, or perhaps you don't know yet, or you don't think that they will actually have a significant impact. So the things we're talking about that might be favorable, that might impact your bank, would be that they, what Kristine just talked about, no expiration for NOLs, which is quite a positive. If you have a change in ownership situation, you might be subject to limitations under Section 382 or such. Another positive thing might be fixed asset expensing, although we've seen that around for many years. Unfavorable, as we're going to talk about in the later slide, might be that corporate AMT isn't off the table. It's one of those things that is still in some of the bills, so we'll see how that is, the outcome on that. There's phase out of several tax credits, and then the changes in the tax exemption on private activity bonds are definitely unfavorable for those institutions that have made investments in those types of vehicles. Let's see. As far as the results, I'll give you all a couple minutes to provide your answers and hit the submit button. Right now, it looks like there's 0 of 91 submitted. So I do see that there are answers in there. So I don't know if that's a technical issue, but I will go ahead and, oh, now I see 80% submitted, so that's perfect. Okay, so I'm going to go ahead and publish these answers. And it looks like more than 50% say that it's a mix of favorable and unfavorable, and I think I would agree with that. There's a lot of moving parts here, and I think that it'll take us a while to figure out, you know, where exactly everybody in their individual situations, whether on an individual level or on a institution level, where they benefit and where there is a detriment related to this. All right, and now we're going to talk about some cost recovery for tangible and intangible property with Kristine. All right, Kristine, are you there?
Yes. I apologize, on mute. So one of the things that we saw as these bills came together was the encouragement for taxpayers to go out and spend money on fixed assets, rush out, purchase your equipment and such. And one of the limitations that was put on that was related to the ability to expense interest expense related to these purchases. And so the way that that was built in is net interest expense. So we scope out banks because we end up with net interest income, but net interest expense would be limited. They've got a unique way of looking at it, but essentially businesses with excess of 30% of their income as being interest expense would be limited, and that would cause a carry forward to be available. And what we see in terms of your client base is that 25 million or less under the House plan, or 15 million or less in average gross receipts under the Senate plan, those are scoped out of these provisions. So in talking to a number of our clients, they feel like their borrowers will largely be in a position where they can continue to deduct under either these exemption provisions, or because they're not so burdened with interest expense relative to their income that they're able to deduct it as being less than 30% of that threshold. In terms of other provisions out there that impact the top and bottom ends of the size spectrum, cash basis method of accounting, this is commonly one that, as we saw de novo banks back in the day move up to size, banks are able to be on the cash basis up to $5 million and in average gross receipts, and those thresholds have moved up to $15 million or $25 million under the various plan provisions. And so that, if you're an institution that's sitting below either that 15 or 25 million threshold, now is a great time to be thinking about whether a method change would make sense to switch, say, back to cash basis in 2018 if we don't see tax rates change until 2019. So something that we can be keeping our eyes out for as we see how the final bills come together. On the very other end of the size spectrum, FDIC premiums for banks with greater than $10 billion in assets see a phase out of their FDIC premiums. And so that's a complete phase out at $50 billion, but that $10 billion threshold is where you'd start to see some level of phase out of your FDIC premiums. So as we saw with our last polling question, there's some details regarding corporate AMT in the bills. So the House bill does provide for corporate AMT to be repealed. So a number of banks do have AMT credits as a result of working through net operating losses. What we see there is that those AMT credits still have value. The way they would be used is 50%. You can offset 50% of your tax in 2019 through 21, and then up to 100% of your tax from 2022 forward. And so those details are in the House bill. In the Senate bill, we actually saw that AMT was not addressed. That portion of the bill was dropped as they worked through the edits over the last couple of days. For people that dig into the bills and get overly excited about all things tax law, like Amy and myself, looking at that, it seems to be a flaw or a oops, we ran out of time to deal with it part of the bill, because the consequences there seem like they're going to be unintended consequences. So I expect we'll end up closer to what we're seeing with the House bill. Something to be aware of is when you think about you as banks, what is included in alternative minimum taxable income, it's things like BOLI, like tax-exempt interest, and those are items that get added back to come up to alternative minimum taxable income. So if the Senate bill is upheld, things like BOLI and tax-exempt income will then be taxed at a 20% tax rate, so you wouldn't actually see a cash benefit from having those items. And that's why I believe, and a number of folks out there digesting the laws believe, that it's dealing with some unintended consequences, and I expect we'll see relief, or a number of these provisions that clearly would tip you into having things that normally would be tax exempt become taxable on a cash basis will have some impacts to the way that you're accounting for your payments to the IRS. International tax changes, won't spend a lot of time here outside of a number of borrowers I expect do cross-border transactions. The idea here, a significant provision in these reforms, is moving to a territorial tax system and looking at removing some of the barriers to repatriating earnings. And so this was a significant piece to also helping to bring more dollars back into the U.S. as you look at balancing these and making it more consistent with what we see from a worldwide international tax system, being more consistent with what you see other countries around the world doing. Mortgage interest deductions for individuals, for those of you with, again, serving 1 to 4 families or families with mortgages. One of the things to be thoughtful about is the House bill does look at, on new mortgages, limiting the interest to the first $500,000. And so currently those rules are at $1 million, where you can deduct interest expense up to the first $1 million borrowed. And so this would result in a smaller deduction in terms of itemized deductions. And if we look to The home equity loans, currently the bills allow you to deduct interest on up to $100,000 of home equity loans, and in both in the House bill, that provision no longer provides for deduction, and likewise in the Senate bill, again, no deduction on interest for home equity loans.
All right.
These
so
again.
Go ahead.
I was just going to say, these again are for loans going forward, so existing loans are grandfathered in.
Oh, good point. All right, so that brings us to our next polling question. So this is the question of the day, of the year. When do you anticipate the bill will be signed into law? So if the bill is signed into law in 2017, then we will see the impact to the deferred tax asset change in 2017, even though the rate change may not be effective until 2018. And that's because you would be reflecting the value at which your deferred items would be reversing at. And you wouldn't reflect the income tax expense related to a current year liability for the rate change. Your current wouldn't be impacted until 2018. So I know that the President and the Republicans have discussed a lot about getting something pushed through, signed before Christmas. Is that even possible? I know things have been moving pretty quickly. And in fact, during presentations earlier in the year, in the end of October, I was not even certain that tax reform would get passed. So we are seeing a lot of very quick movement. So just a couple more minutes, and then I'm going to publish the results of these answers. It looks pretty split across the board, although there's very few people that don't think it will get signed in the near future. Everybody's pretty optimistic that it will get signed based on one of these options. I am going to go ahead and submit these responses now, and we can take a look at them together and see the results. They are split practically 33%, 1/3 for each of these top three options, with only a very small percent with not signed at all. So it could be any. It's up in the air as to what the result would be, and it's very hard to speculate. And we will talk about what that means with planning around these uncertainties, though. Kristine, if you want to share your thoughts on that.
Perfect. So the item of intricacy, if we look at how you measure your deferred tax assets in the event of a rate change that would occur in 2019, I do want to spend a little bit of time here because it's something that is possible. So if we think about our deferred tax assets, the way that the codification looks to measure them is at the rate they're expected to reverse. So if we see this signed into law in 2017, we would need to revalue our deferreds at the rates they're expected to reverse. So if the rates apply in 2018, that becomes a little bit more simple of an exercise because you simply take all your deferred tax assets at the new 20% rate, and that's the new value of your deferred tax asset. Where you see some additional complexities is if you say, here's all of our timing differences, and the rate changes apply in 2019, then all of a sudden you have to think about which one of these deferred tax assets and liabilities get measured at 35% because they'll be reversing in 2018, and which one of them get measured at 20% because they'll be reversing in 2019. So the one thing to be keeping your eye on is if we do see this legislation move in a direction where it's signed before year end and the measurement is not going to lower the rates until 2019, there will be some additional complexity to doing your deferred tax calculations because you'll have to go through the extra step of assessing when your timing differences will reverse. So if you look at something like accrued expenses or prepaid expenses that reverse every year, those items simply would be at the 35% rate because it would reverse the following year in 2018. If it's something like your allowance for loan loss where you don't expect it to reverse for a number of years, then that would be valued at, say, a 20% rate. And so that's just to get ahead of the discussion that if you see legislation moving quickly before Christmas, you see those rates hitting towards 2019, that should be a big red flag that you've got a lot of work to do between Christmas and the time that you close your books, because again, this all impacts your P&L, and you'll want to make sure that you have those set to go, especially if you're a public company and you've got those tight timelines in terms of getting press releases out and all that goes with that. It'll make a lot of work to be put into a concentrated amount of time. Let's see, in terms of what to expect during the compromise period, so what occurs from here is right now the House has passed their bill, the Senate has passed their bill, and then the two parties have groups that come together that essentially hash out to land on a bill that is exactly the same between the House and the Senate. And so then those bills go back to each of those parts of Congress, and each would need to pass the exact same bill. So that's what needs to occur between now and the end of the year if we do see this passed in 2017. And again, it's going to be a period of compromise, which then goes back to have each branch or each part of Congress vote on the exact same bill, and then that bill does go to the president for signature. With that, we'll move to our brief state tax update.
Correct. So we noted that there were a lot of attendees from many different states, and probably more than I have captured on the slide. So we're just going to talk about some of the trends in general. States, as Kristine mentioned, are going to be more aggressive than they have been because they're going to recognize a fallout related to some of these things. So we may see that there is not conformity with regard to some of the bonus depreciation, Section 179 that currently exists. But I think over the next couple of years, we'll see more of that. One thing that the states are being more aggressive on is looking for people to file, and also with regard to non-income tax matters, such as sales tax reporting. They're looking for greater compliance. So in general, a financial institution might have a exposure to taxes in another state if they have loans that are secured by property in that state, if they have services that they're providing to customers located in that state, or if they have employees working in another state. And we're seeing this more and more where institutions that only filed in the states where previously they had branches are now filing in states because of other reasons. And it's not unusual, and especially there's a trend for more of the states to be moved towards market-based sourcing, which we'll see for Oregon that happened this year. If you're in California, you would see that the California Competes tax credit is in its final year, but there are still credits available if you are looking about thinking about expanding your activities in California, might be something to look into. And then also with regard to the wildfires that took place earlier in the year, California is offering some property tax relief. With Oregon, as I mentioned, they're moved to a market-based sourcing, which is new, so this is starting in 2018. So if you have customers that are receiving benefit from services in Oregon, that creates a potential filing requirement. What we're doing is we're recommending that everybody reassess their state tax position so that even if they're not filing in a state, they know what their state tax exposure is to each of the state. And it's usually going to be if a customer receives the benefit from services in that outside state, or if there is real property that is securing a loan in that state. Also in Oregon, they did kind of a funny thing where they said that the application of the overpayment isn't going to impact first quarter, it'll impact the quarter that the tax return's filed, which is most likely going to be third quarter. So this is going to mean that you'll want to decouple your first quarter payment from your extension payment, as is the usual trend, so that you have enough of a coverage in your first quarter estimate. With regard to information returns, we wanted to let you know, and it seems like we've been talking about this forever, but starting with the 2017 1098s that are going to go out in early 2018, there is additional modifications to the mortgage reporting that need to be included. The date of the mortgage was originated and the address of the property securing the mortgage need to be reported, along with the outstanding principal at the beginning of the calendar year. We also want you to be aware that the IRS is using the information return penalties as a revenue raiser, and so they've been aggressively increasing their computer-generated penalty assessments, which are actually quite large. We see them $100,000 assessments, and they can get even higher. What we want you to know is that there is relief for that. Because the assessments are covered under different code sections, though, we ask you to be careful when responding to them to make sure that the language that you're asking abatement for is the specific language that the IRS is assessing the penalty under. So we recommend that you discuss this with a tax attorney, because the penalties have been very long. I'm not going to go into any more detail on that. We just want you to be aware of it, and you should go through your systems and make sure that you have good matching identification techniques with the EIN of the taxpayer and their name combination. And in the handouts, we have several suggestions for corrective action and for how you can update your systems to avoid penalty assessments in the future. All right, so Emily, I am ready to wrap up, and I will have you go ahead and present closing statements.
All right, thank you. Thank you, Kristine and Amy, for a great presentation. We obviously covered a lot of material. We didn't get to all the slides today, but feel free to download these slides from the slide deck and handouts widget to the right of your slide view. And if you asked a question that we didn't have a chance to respond, we'll be happy to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, Your certificate is available to download now in the CPE Progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate now. A copy will be emailed within 2 weeks should you have any difficulty downloading it at this moment. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.